Hi there. Welcome to the last video in this module. I'm going to talk now more about hedge funds and the computing infrastructure that they use. And this will form sort of the basis for much of the rest of the class. We're not going to be able to do, in this class, implement a full hedge fund. We're just going to be able to implement parts of it. But I want to put it in context so you understand how what we're learning in this class relates to the bigger picture. Okay, I'm starting sort of from the market and working back, and the general idea here is a hedge fund somehow or another has come up with a target portfolio. So it's a list of positions that they want to be in because they think Bank of America, say, is going up and Apple is going down. So they're shorting Apple and going long or buying stock of Bank of America. Now, once we'll talk in a few moments about how they get that. But suppose you have this target portfolio. How do you execute that in a market? And because we've been talking about the exchanges and brokers, let's start from there and work back. So let's assume the earlier part we talked about. That's all over here, the brokers and the exchanges. And now what we're doing is we're issuing orders. They're getting executed. And we're continuing this cycle. Now, for the purpose of this video, we're not doing HFT. We're not doing high-frequency trading anymore. High-frequency trading is great. I know people who make lots of money doing it. But we're going to be talking about not trading on milliseconds, but trading over seconds and days. Okay. All right. So. Again, let's assume we have this target portfolio. The market opens, and at market open, the portfolio we currently hold and our target portfolio are the same, but we want to cause our live portfolio to be the same as our target. So what we need is a trading algorithm that compares the two and issues appropriate orders to get these two in line. Now, something that's important to point out, you might wonder, okay, gee, my target portfolio is I want to be short Apple 100. My current portfolio is that I'm long Apple 100. Yeah, so to get there, I may want to sell 200 shares of Apple so that it evens out to what I'm looking at. So you might ask, well, why isn't my trading algorithm just to take the difference and issue the orders to make that happen? Well, if you're trading a small portfolio, by small I mean $1 million, maybe less, you can just directly execute these trades like that to get your target and your live portfolio in line. The thing to keep in mind, remember when we were talking about how orders cause prices to change? Well, if you put out lots of large orders, you're going to cause the market to move against you, and the efficiency of your ideas and of your portfolio is going to be hampered by the changes in price. So often these sorts of trading algorithms don't just directly make the orders that bring the portfolio in line. They make lots of small orders to cause it to happen slowly and not affect the market so strongly. Sometimes you hear news about prices going wild because someone fat-fingered a trade. What that means is someone wanted to sell $1 million of a particular equity, and instead of doing it slowly over several days, they did it all in one trade, and boom, the price got slammed and it hurt their portfolio. So trading algorithms stretch that out over a longer period of time. You put your orders in, they're accepted or not by the market. That adjusts your portfolio, and this cycle continues until your live portfolio is in line with your target portfolio. Okay, so that's at the trading end. Let's move back a step. Where do we get this target portfolio in the first place? Well, of course, it depends. It depends on the hedge fund or the investment bank exactly where they get their intuition or knowledge about which way a stock is going to go. But a way to treat this is to assume that from somewhere we have a forecast. We have some insight into the future about what the future prices of stocks are going to be. Here we think Apple is going to go down 1%. We think Bank of America is going to go up 5%. We think Delta is going to go down 2%. These forecasts may be generated by people. They might be generated by machines. But somehow or another, we have this insight into the future, and we want to translate that into a target portfolio. This is where a piece of computing called a portfolio optimizer comes in. We'll talk more about it in a later session, but this algorithm is able to take a look at where we think prices are going to go. They also look at historical prices, and combining all of that information, come up with a new target portfolio. Now, you might say, why do historical prices matter? Well, it turns out that if you want to reduce risk in your portfolio, in other words, let's say this is one equity you own, say it's fairly volatile. Well, if you can buy a little bit of another equity that zigs when your stock zags, your net portfolio is much smoother and less volatile. And historical prices can be used by portfolio optimizers to realize that. They can observe the correlation between stock prices and other stock prices and balance your portfolio so that you can reduce that volatility. You also need to consider your current portfolio because, again, you might not want to very immediately, say, make a huge sell of, say, Apple or whatever equity. And the portfolio optimizer takes in things called risk constraints, considers all this, and says, okay, this is where I want my portfolio to be. And again, going back to that slide just a moment ago, once we have that target portfolio, we then interact with the market to get our target portfolio in line with, to get our live portfolio matching our target. Okay, let's talk now about where does that forecast come from. So it can come from people. Maybe you like Kramer on TV. I don't know. I kind of like Kramer. Maybe your broker sets price targets that you like, or there's some analyst, and you can someone thinks Apple's going to go down. You can use that to create your forecast. I like to consider it in the context of a forecasting algorithm. And in fact, my research and the work that I do at my company is to use machine learning to come up in this algorithm to make these forecasts. Now, we're not going to talk about machine learning in this course, but we will talk about it in a follow-on course, in particular part 2 of computational investing. Anyways, how do we make these forecasts? Usually, almost always, there is some sort of information we've got that we think is predictive. It may be news. Bad news comes out, we think the stock is going to go down. Good news comes out, maybe we think the stock is going to go up. But some sort of information, it's usually quantitative, meaning there's numbers, and we develop some sort of algorithm that based on these numbers makes a future forecast. And again, we like to have historical information so that, for instance, we can look at previous patterns in stocks, combine that with the information to make a forecast. And just about anything can be here in this box. It can be machine learning, like I said. It can be a human. But the important part is that what comes out of there is a forecast. We then take that forecast into our optimizer, get our target portfolio, and take that to market. One last thing I wanted to talk about before closing is about these information feeds. Remember, we were talking about high-frequency trading. That hedge funds that have machines co-located on exchanges. Well, in some cases, now this infrastructure that I'm talking about here is, let's just say, low frequency. So let's not consider that for a moment. Let's think about information feeds in the context of high frequency. One product that Thomson Reuters has, they'll send you individual packets, internet packets, when news comes out that include the symbol of the stock and binary, good news, bad news. That can be shipped directly to your machine that's on the exchange. It's in a single packet, so it's transmitted as fast as possible. Your machine on the exchange can immediately process that and buy or sell as appropriate. Lower speed types of information feeds are things like analysts, estimates. There are many analysts that follow each stock in the stock market. In terms of forecasting algorithms, it's not unusual for hedge funds to build models. In other words, how they might trust one analyst more than another, and use that model based on analyst estimates to inform their forecast. Anyways, this side of things can take many forms, but the way to think about it is there's always some kind of information informing our forecast, and we carry that forward. Okay, that's it. Quick recap of what we've covered in this module. Order types, buy, sell, limit, market. We talked about how the order book works at exchanges, how buying and selling drive prices up and down. Talked about the basic infrastructure of an exchange and brokers and market makers. And in this last video, we talked about the computational underpinnings of a hedge fund. That's it for this module. Look forward to seeing you on the next one. So long.